Have you ever noticed how one geopolitical event can suddenly shake the entire global financial system? Oil prices jump, gold surges, stocks fall, and headlines everywhere start talking about crisis. But here is the real question. Is this the moment to panic or the moment to understand what smart investors are actually doing? In this video, you will understand how rising tension between the United States and Iran is influencing global markets, why oil, gold, and certain stocks react so strongly, and most importantly, how intelligent investors think during uncertain times. By the end of this video, you will clearly understand which sectors historically benefit during geopolitical conflicts, which sectors struggle, and how long-term investors turn uncertainty into opportunity. Let's start with what actually happened. Recently, tensions in the Middle East increased after strikes by the United States and Israel targeting Iranian facilities. Whenever events like this happen, global financial markets react. Immediately, investors around the world begin adjusting expectations within seconds because markets react to fear, risk, and uncertainty about what might happen next. The first market that usually reacts to Middle East tensions is the oil market. The reason is simple. A large portion of the world's oil passes through a narrow waterway called the Strait of Hormuz. Even though it looks small on the map, it is one of the most important routes in the global economy. Nearly 20% of the world's daily oil supply moves through this passage. When markets begin worrying that this route could be disrupted, traders start pricing in the possibility of reduced oil supply. When supply is threatened, prices usually rise quickly. That is exactly what happened. Oil prices jumped as traders reacted to the risk of supply disruption. Analysts even warned that if the Strait of Hormuz were ever blocked, oil prices could rise dramatically. Rising oil prices affect much more than just energy markets. Oil powers transportation, manufacturing, shipping, airlines, and many industries around the world. When oil becomes expensive, the cost of producing goods increases. Airlines pay more for fuel, shipping companies pay more for transport, and factories pay more for operations. Eventually, these higher costs reach consumers. When businesses face higher expenses, they often raise prices. This leads to one of the biggest concerns in economics: inflation. Over the past few years, central banks have already been fighting inflation by raising interest rates. Higher interest rates slow borrowing and spending, which helps reduce inflation. But if oil prices stay high, inflation could rise again. And if inflation rises, central banks may keep interest rates higher for longer. Higher interest rates can create pressure on stock markets because borrowing becomes more expensive for businesses and consumers. That is one reason markets become volatile during geopolitical conflicts. Investors dislike uncertainty, and financial markets react quickly when risk increases. However, there is something important many people misunderstand. When headlines say the market is falling, it does not mean every stock is falling. During geopolitical crises, markets often rotate rather than collapse. Money moves from one sector into another. Some industries struggle while others benefit. For example, the energy sector often benefits when oil prices rise. Energy companies sell their products at higher prices, which can increase profits. Investors understand this, which is why energy stocks sometimes rise during oil price surges. Another sector that can benefit is defense. When geopolitical tensions rise, governments often increase military spending. Countries invest more in defense systems, technology, aircraft, and weapons. Defense companies that produce these technologies may receive larger contracts and increase demand. At the same time, some industries struggle. Airlines are very sensitive to fuel costs. When oil prices surge, airline expenses increase significantly. Transportation and logistics companies can also face higher costs because shipping goods becomes more expensive. This shows that markets rarely move in one simple direction. Instead, they adjust. Money flows away from some sectors and toward others. Investors who understand these movements are better prepared for uncertainty. Another common reaction during geopolitical crises is movement into safe haven assets. When investors become nervous, they often move their money into assets that historically hold value during uncertain times. Gold is one of the most famous safe haven assets. For thousands of years, gold has been considered a store of value. During periods of political tension, economic instability, or financial uncertainty, investors often buy gold because it is not directly tied to any government or company. This is why gold prices often rise when geopolitical risk increases. Investors see gold as a way to protect value when markets become unpredictable. But here is an important lesson. Experienced investors understand. Short-term market reactions are often driven by emotion. Fear spreads quickly and headlines amplify uncertainty. History shows that markets have faced many crises before. Global conflicts, economic shocks, and financial crises have all created fear in the past. Yet over time, markets recovered, businesses adapted, and economies continued growing. This does not mean crises are harmless. They can create real challenges and temporary disruptions, but they rarely destroy the long-term growth of the global economy. This is why experienced investors try to remain rational during uncertain times. Panic selling has historically been one of the most expensive mistakes investors make. When people sell assets simply because prices are falling, they often lock in losses and miss the recovery later. Smart investors focus on understanding what is actually changing. They ask whether the long-term economic system is damaged or whether the market is temporarily reacting to uncertainty. Another factor investors watch closely is inflation. If oil prices remain high for a long period, it can increase inflation across the global economy. Higher transportation costs lead to higher product prices, and consumers eventually feel the impact. If inflation rises, again central banks may adjust their policies. Interest rate decisions influence borrowing, spending, and economic growth, which means they also influence financial markets. But there is another lesson. Long-term investors remember, during uncertain times, crises can also create opportunities. When fear spreads, many investors rush to sell assets simply because prices are falling, but sometimes those falling prices have little to do with the long-term strength of the business. Strong companies can become temporarily undervalued during market panic. For patient investors, this can create opportunities to buy quality businesses at lower prices. Throughout history, some of the best investment opportunities have appeared during periods when markets were dominated by fear. This strategy requires patience, discipline, and emotional control because during uncertain times, human psychology pushes people to react quickly. But successful investors often slow down, analyze carefully, and focus on long-term outcomes instead of short-term noise. If we look at the bigger picture, the global economy is incredibly resilient. It includes billions of consumers, millions of businesses, constant innovation, and continuous adaptation. Geopolitical conflicts can create disruptions, but historically, the world economy has continued moving forward. Trade continues, technology advances, entrepreneurs build companies, and industries evolve. This resilience is one of the reasons long-term investing has historically worked. So when you see headlines about geopolitical conflict shaking markets, remember that volatility is part of investing. Markets rise and fall, prices fluctuate, and unexpected events create temporary shocks. But over the long run, economies grow, innovation continues, and opportunities appear for those who remain patient and rational. The moral lesson is simple. Fear reacts quickly, but wisdom moves slowly. When uncertainty appears, the smartest decision is not always panic. Sometimes the smartest move is to stay calm, understand what is really happening, and think like a long-term investor. If you want to keep learning how money, global events, and financial markets create opportunities, make sure you subscribe to the channel Arsam Explains Money.